Yes. All right. So Jedi Options today, we're going to build a swing trade using a call option on a bull retracement pattern. So I'm going to identify the pattern, talk through the technicals, talk about how to pick a call option, which month and strike, and then how to structure the trade, right? So this is going to be, I think, a good illustration here. As we've talked about today, no shortage of bull retracement patterns. If the market wants to make our lives easy, it will bounce in the next couple of days. If it doesn't want to make our lives easy, this pullback will continue, or maybe it'll go up one day and then come right back down. I'm not in control of that. All I'm in control of is finding a good pattern, putting the risk reward in my favor, and mapping out a good trade. So GT was, I believe, on our scattering report this weekend. Certainly emblematic of the type of stock that was on our report. We had a lot of bull breakouts, and we had quite a few bull retracements. And we actually had to cut quite a few because there were so many choices here. Look at the pattern. Glorious recovery off of the lows, rises end of July through August, good increase in momentum. How do you know it's an increase in momentum? Look at the distance between the pivots. Pivot high, higher pivot high, higher pivot high. Look at the distance, right? Massive move on the second swing relative to the first swing. That's what we call an increase in momentum. That wasn't obvious enough. You can see the separation of the moving averages. 9 EMA ripping, 20 SMA ripping, 50 MA climbing but slower. So you get the separation in the MAs when you get the increase in momentum. Little too hot to trot here. Listen, it ran from 11 to 15 and a half. Needed a Gatorade. It needed a rest. It pulled back 1, 2, 3, 4, 5 bars into today's trading session. 5-bar pullback. You take a look at the volume, which is skewed because you had a big volume spike a ways back, but nothing that worries me, right? No major volume spikes, no major distribution, which suggests garden variety profit taking. Okay, just run of the mill, ringing the register. No major bear raids, no major distribution among institutions. Listen, ran a bunch, needs to pause, sellers come in, pulls back. I like the spot. It's right between the 9 EMA, the 20 SMA, logical area for bulls to say, enough, let's move on, let's continue the trend. All we've been waiting for is confirmation, okay? Didn't get it yesterday, didn't get it on Monday. Looking like you're getting some today. This is a forming bullish engulfing bar, okay, on the backdrop of a market that's rallying. I like that. And so this is, like I said, pretty textbook. You take a look at the risk reward. If I'm going to buy this over, let's really zoom in here. Let's say I buy this over yesterday's high. That also gets me above the 9 EMA. Okay, let's say I stop today's low and I target the pivot high. Look at the distance between the entry and the stop and the target. Okay, entry to stop, risking a little, entry to target, you can make a lot. That's a textbook over 2-to-1 reward to risk ratio. That checks the box. So from a pattern perspective, pristine, not really much you can say bad about this guy. Okay, you want to quibble over breaking the 9 EMA, feel free. Okay, but you got a lot of pullbacks that break the 9. Breaking the 20 matters a little more. I'm going to give it a pass given the depth of the broad market retracement. Can I throw in one other thing here? The other thing is, if you want to look at this from a fib perspective, bring up the fibs for a second. Listen, I do this so rarely. I missed on my first 2 attempts. Send the drawings. You take a look at the fib retracement here. It has retraced 38.2 of its prior advance. You're going to be mad at this for retracing 38.2 of the prior advance? Nonsense. It's fine. It's garden variety. This is a fair spot to retrace to. Okay, so how do I want to play it? Listen, it's a $14 stock. What do you think I'm going to do? You think I'm going to build some kind of complex spread? Why? It's cheap enough. You could buy this straight, buy the stock. The reason you would go to options is not because you want to get fancy with a spread. It's more so because you either want to buy a call or you want to sell a naked put. And in this case, we're going to go with the more directional play. Partly because we're rewarding the stock for being so darn bullish, right? It's aggressive. It had good momentum on the last advance. Why not lean into that and go for a strategy that pays you more if this gets back up to 16 bucks? So I'm going to go with a long call. It's going to be cheap. It's going to be cheap. What month would I buy? What month would I buy? September, 23 days, a little too aggressive for my taste. I like the October time frame. December is just unnecessarily long, in my opinion. So I'm going to go with October. Our run of the mill rule for buying a call option is to go out a couple of months minimum, buy a 60 delta, usually 1-2 strikes in the money. In this case, the first strike in the money is a 60 delta, 59.5, we'll round it to 60. 14 strikes, stocks at 14.40. You're 40 cents in the money. It's going to cost you about $1.40. 40 cents of that is intrinsic value. You're paying about $1 for the time. Paying $1 for 60 days of time. I think that's fair. So I like this call as the strike that we're going to purchase. How do you build out the order? Listen, if you wanted to buy it immediately, you would just buy it at the midpoint, $1.40. Boom, buy it, done. If you say, no, not so fast, I want a little more upside confirmation. Okay, I want this to take out the 9. I want it to take out yesterday's high. All right, well, yesterday's high was $14.50. You're 10 cents away. You could set an alert. You could sit here and wait, or you could automate it. So I'm going to click on this little cog wheel. This is where I can tie the option order to the stock price. So right here, I can add a condition, and I can say if GT gets at or above 14.50, then trigger my order, then buy it. Well, what order do you want to trigger? What order do you want to send to the marketplace? It's not going to be worth $1.40 anymore. Okay, so you can't do buy limit $1.40. That's where it's at right now. If the stock goes up 10, 15 cents, it's probably going to be $1.50 or $1.55. I don't know. You could guess. You could say, well, I don't think it's going to go any more than $1.55. So I'll just throw out a limit order to $1.55. And if it can get it at $1.50 or $1.45, it will. But I don't really want to have to guess. So what I would prefer to do if you're intent on using a limit order is just link it to the mark value, which is the midpoint. And so when the stock breaks yesterday's high, it'll route a limit order and it'll look at the bid-ask spread at that time. And if the bid is $1.50 and the ask is $1.60, it'll route a limit order at $1.55. That's the mark value. That's the midpoint. Okay. So you could do that. Or you could say, I'm okay with the liquidity. I'm okay with a market order. I don't want to run the risk that I don't get filled. Just get me the heck in with a market order. Okay, that's fine. Just know that if it gaps up tomorrow or if it gets filled right off the bat when the market opens, bid-ask spreads might be a little wider. You may not get as good of a fill. Okay, so I'm going to go with the more conservative route. I'm going to route a limit at the midpoint. That's the entry. Okay, that's the entry. Now, do you want to put in a stop loss? Listen, your call. I mean, if you pay $1.40 for this, that's your risk, $1.40. If you're willing to risk what you pay with a long call, technically you don't need a stop loss. Okay, technically you don't need a stop loss. But I'm going to assume you don't want to risk the whole $140, and you want to get out if it takes out today's low. And in fact, I'm going to put it below the 20-day moving average. Okay, give it a little bit more room. So the 20 MA is at $13.85. So to be able to put in a second order as my stop loss, I'm going to go to advanced order and change it to first triggers all. And then I'm going to create a sell order. Now, there's a couple ways you can do it, but what I'm going to do is I'm going to come back to the October 14 call and click on the bid price to bring up a sell order. Now, when do I want to sell it? Well, I want to sell it if we break the 20-day moving average. So again, I go to the cog wheel. I put in the condition if GT gets at or below, hang on one second. I clicked on the right one, yes. Yeah, if GT gets at or below 14, I'm getting old, I already forgot. 1385, right? 1385, all right. So if GT gets at or below 1385, let's call it 1384, sell my call option at market. I could route a limit order at the midpoint, but honestly, I don't want to run the risk that I don't get filled. So if I want to ensure that I get filled, I'm just going to route a market order at that price. Okay. How much am I going to lose? I got to analyze it. Right click on the buy order, analyze the trade. It's going to pop open the risk graph. Okay. This is what the long call risk and reward profile looks like. If I get in now, hang on a sec. Let me set this at $1.45. Hang on, guys. Let's do it this way. All right. Better. But let's say you end up buying it at $1.45. Okay. And in fact, you're probably going to buy it maybe at $1.50. All right. If it goes down from $1.50 down to $13.85, what am I now? $40? I mean, I'm not risking a lot. Now, $40, you put up 150. So, I mean, you're risking about a third of what you paid, which quite frankly, that's typical for a long call option. These guys move so fast. Even with a well-placed stop loss, you're probably down about 30% of the purchase price of the call option. So the $40 kind of resonates with or jives with that rule of thumb. Okay. So risking $40 or so per contract. Now, for me, I wouldn't place a target. I would rather move the stop up or make the decision in the moment. I like presetting the entry. I like presetting the stop. And then I just kind of like monitoring it or setting an alert up near my target and making the decision when we get there as to how I want to manage. Do I want to take profits? Do I want to move the stop up? I like having the alert there to remind me that's my decision point, right? And listen, that's it. That's it. That's a bull retracement on GT. That's me selecting, I think, a smart call option, placing a stop loss. And then I'm just rooting Goodyear on. I'm saying, GT, let's do this, baby. Break the 9, give me a trigger, run to 16. And then we see what happens, right? Your move, GT. I've got my trade in. Let's rock and roll.